investors and the president of the government agency responsible for recovering money from fraudulent brokers. Congressman Paul Kanjorski chairs this 3.5-hour hearing.
This hearing of the Subcommittee on Capital Markets, Insurance, and Government-Sponsored Enterprises will come to order. I ask unanimous consent that permission be granted to anyone, a non-member of the subcommittee, who comes present today to sit with the subcommittee. Pursuant to committee rules, each side will have 15 minutes for opening statements. Without objection, all members' opening statements will be made part of the record. Good morning, everyone. 1 year ago this week, federal authorities arrested Mr. Bernard Madoff for participating in the largest Ponzi scheme in U.S. history. It is therefore appropriate for us today to meet for the third time to examine this massive securities fraud. As my colleagues know, I have sought to use the $65 billion deception as a case study to guide our work in reshaping and reforming our financial services regulatory system. Last month, our committee passed H.R. 3817, the Investor Protection Act, and we have now rolled this important securities reform bill into H.R. 4173, the Wall Street Reform and Consumer Protection Act, which the House will begin to consider today. Both bills contain a number of provisions that directly respond to Mr. Madoff's substantial swindle. The repeated failures of the U.S. Securities and Exchange Commission, despite having received several leads from a number of sources to detect the Madoff fraud, allowed the hoax to continue for more than a decade. A lack of effective coordination, sufficient funding, and staff expertise each contributed to this unfortunate regulatory breakdown. In response, our bills double the authorized funding of the Commission for 5 years to ensure that the agency has the resources it needs to hire staff with appropriate expertise and to get the job done. The bills also provide for an expeditious, independent, and comprehensive review of the entire securities regulatory structure by a high-caliber entity with experience in organizational change. This study will identify specific reforms and improvements that the Commission and the other entities that oversee our securities markets must put in place to ensure superior investor protection going forward. Mr. Madoff's episode also revealed the need to elevate the importance of whistleblowers like Mr. Marco Polo, who made repeated entrees to the Commission regarding Mr. Madoff's con, by establishing incentives so that more of them will come forward. Our regulatory reform package, therefore, includes a bounty program to help identify wrongdoers in our securities markets and reward individuals whose tips lead to successful enforcement actions. With a bounty program, we will effectively have more cops on the beat. In studying the Madoff case, we have additionally learned that the Public Company Accounting Oversight Board lacked the powers it needed to examine and take action against the auditors of the broker-dealers. Our legislation closes this loophole so schemers like Madoff will no longer be able to rely on inept or corrupt accounting firms to rubber stamp their criminal activities. Through our investor protection reforms, we have further sought to strengthen the Securities Investor Protection Act, the law that helps investors to recover funds when a broker or dealer fails. We have increased the resources available to the Securities Investor Protection Corporation to fund liquidations, boosted the level of cash coverage an investor is entitled to, and raised penalties on brokerages for violations of the law. We have also broadened the eligible types of investments covered. We can, however, do more to reform this law. Today, we will continue to move this process forward as we examine the ongoing efforts of the Securities Investor Protection Corporation to mitigate the sizable losses of Mr. Madoff's victims, as well as the casualties of the $8 billion Stanford financial fraud. We will also explore the intended and unintended consequences of several proposed changes to the Securities Investor Protection Act that aim to address problems that some Madoff and Stanford financial victims, including retirees, pension funds, charities, and others, have encountered. While each of these amendments seeks to fix a perceived deficiency in the law, each proposal would also benefit from a robust debate in order to identify potential problems and possible refinements. Some, for example, have advocated that the Securities Investor Protection Corporation should not claw back the profits taken by earlier investors who unwittingly partook in a Ponzi scheme. I have concerns that such a plan, if implemented, would treat later investors unfairly. That said, clawing back profits already used by charities could prove especially devastating. As such, we must walk a fine line in determining how to proceed, if at all. In closing, I would like to extend my appreciation to my colleagues from New York, Mr. Ackerman and Mr. Maffei, as well as Mr. Ellison of Minnesota, Mr. Klein of Florida, and Mr. Perlmutter of Colorado, who have helped to select today's witnesses and advance discussions on reforming the Securities Investor Protection Act. Together, I hope we can learn more from these troubled events and figure out how we can further improve our regulatory system. Now, I'd like to recognize our ranking member, Mr. Garrett, for 5 minutes for his opening statement.
And I thank the Chairman, and I thank all the witnesses, too, for joining us today to testify before our subcommittee. And from people similar to you, situated as yourself, I've been informed and keenly aware of the suffering that has been suffered and inflicted on so many investors in my area, in the 5th District in New Jersey, and across the country as well, due to the Madoff situation and the Stanford fraud as well. And so, Mr. Chairman, it is important that we hold this hearing today to hear firsthand from some of the victims, not only really just to get a better understanding of their situation and their plight, but also to hear your ideas, having been through this experience personally, and how to make the SIPC process work better, and perhaps more importantly and appropriately for all the interested parties involved. Before I do that, let me just take a moment on my statement. I'd like to seek unanimous consent to enter 2 statements into the record from constituents of mine, those of Robert Jerome and Lenore Shupak, into the record. Both of them have been adversely impacted by the Madoff fraud.
Without objection, so ordered.
Thank you. Now, the frauds themselves were, of course, tragedies for so many innocent victims. And so the purpose of today's hearing, however, is to examine ways to improve the SIPC process so that the victims don't needlessly have to suffer once again. Now, as the Chairman says, there's a number of proposals in front of us today to reform the process. One idea is to offer SIPC coverage to individual investors in a pension fund or other fund, rather than the standard $500,000 in coverage for the entire fund under current law. Others have put forward ideas to reform the so-called clawback process, in which the trustee is seeking to recover funds redeemed by some Madoff investors in the name of equity, returning funds to all the other Madoff investors. There are also calls for a more timely process and advances in extending coverage to affiliates of SIPC-registered brokers as well that we should consider. All of these ideas, I think, deserve to be fully explored and vetted by this subcommittee with a frank discussion of the pluses and some of the minuses as well. This is the least, I think, that we can do for the many investors affected by the past frauds, as well as future ones as well. Because, quite honestly, unfortunately, there will be future schemes that will try to bilk unsuspecting investors. And the SIPC failure to detect, or rather the SEC's failure, I should say, to detect the Madoff situation, despite all the red flags and warning signs and testimony that came to them, is well documented. So we know that this type of thing, unfortunately, could happen in the future. And unfortunately, as Professor Coffey has indicated in his testimony, the level of loss justifies more than just serious reforms that have already been adopted by the SEC. And there I agree. And I'm committed to exploring other ways to improve the performance of that agency. And so I welcome any insights that you may have on this in regard to the hearing today and going forward as well, as the rest of the panel as well. One thing I think, and I'll close on this, one thing I don't think we should be doing as far as the solution to that problem is just saying, let's see if we can just throw more money at the SEC and not asking for any more results from them. Unfortunately, as you probably all know, as part of the Investor Protection Act that was approved by this committee, and that's also part of the package of bills that will be going to the House floor this week, there's an authorization for the SEC to be doubled with basically no strings attached as where the money goes. So my colleague, Congressman Neugebauer, offered an amendment during the committee process here, and I co-sponsored that amendment. And what that would have done would have scaled back future authorization increases for the SEC and instead would have tied any of those increases in money going to the SEC to first for them to have to fulfill some of the recommendations that were made by the Inspector General, basically saying, you have an organization, you didn't do the job, we're not going to reward you by sending you more money unless you can prove to us that you already, over the last year now, have begun to implement some of those changes, and if you want to get additional funding in the future, you'll have to continue on in a better path. So that's one other area I appreciate your comment on. I have a number of other questions related to the witness's written testimony, and so I look forward to hearing your testimony and answering some of those questions. And with that, I yield back, and thank you.
Thank you very much, Mr. Garrett. Now I'd like to recognize Mr. Ackerman for 3 minutes.
Thank you very much, Mr. Chairman, for your continued pursuit of this issue and the series of hearings that you've chaired. It's been a full year since Bernard Madoff folded his own house of cards and admitted that he had operated the largest Ponzi scheme in history. You'd think that by this week, a full 12 months removed from Madoff's admission, our financial regulators, some of whom have admitted they were negligent in protecting investors from Madoff's fraud, would have helped as many victims as they could. You'd think that, given the enormity of Madoff's Ponzi scheme and the human tragedy that it's caused, they would have been as generous as possible. And you would think that because Madoff's investors received detailed, genuine-looking statements, his victims had every reasonable expectation that the money in their accounts was really there, belonged to them, and that they were thus fully protected by the security laws. Sadly, you'd be wrong. Instead, in the years since Madoff turned himself in, the largest, most sophisticated, advanced financial system in the world, rather than providing restitution to the investors in the largest fraud in history, has managed to create classes of victims who have turned against one another, forced to fight tooth and nail over only pennies on the dollar of what they reasonably thought belonged to them, and there is no end in sight. If there's anything we've learned in the years since Bernie Madoff turned himself in, it's that the confidence that investors had in the system, from the SEC's ability to police our markets to SIPC's guarantee of protection against fraud, was misplaced. Today's hearing begins in earnest the process of providing additional legal remedies to Madoff's victims. In my view, there are two issues that this subcommittee must address as we clarify and expand the Securities and Investor Protection Act: a limitation of SIPC's ability to claw back assets from innocent victims who are neither complicit nor negligent in a Ponzi scheme, and finding some mechanism by which SIPC insurance may be provided to defrauded feeder fund investors. I look forward to working together with you, Mr. Chairman, to address these issues in the coming weeks and to hear from our witnesses today. I'd also like to acknowledge that our witnesses who are Madoff victims, and to thank them all for appearing before the subcommittee. There are scores and scores and hundreds, Mr. Chairman, of others who wanted to appear. Most of them just couldn't afford the car fare, the bus fare, the train or plane fare to get here. We appreciate the witnesses who are here, being here with us this morning and testifying, and I look forward to hearing their testimony. And, Mr. Chairman, I would ask unanimous consent that the appropriate place that this folder of statements from additional witnesses be placed in the record.